Good morning and welcome to another edition of the Morgans Edward Street Weekly Wrap. Please let me caution that any advice in this summary is general in nature and you should speak to your advisor to make sure your personal circumstances are taken into account. This week has seen a strong market with the ASX 200 up each day. We've added 50 points over the week to be sitting at 5,880 points. The US has been similarly strong, especially in the tech sector. The Australian dollar is buying 77.8 US cents, which has been quite steady throughout the week, despite geopolitical issues regarding Korea and Syria. Oil has been very strong after the coalition attacks on Syria, with concerned supply will be either disrupted or withdrawn. Oil is trading at $73.80 US per barrel, a price at which the majority of oil and gas producers in Australia will be very happy. Our analyst Michael Knox thinks oil will remain strong and has a target of $81 per barrel. This view is predicated on demand rising via strong economic growth and a lack of new supply coming into the market. Similarly, my view is that oil should be a key part of growth portfolios over the medium term. Earlier in the week, we had a noted fund manager present to our network, and his comment was that you buy banks during a royal commission. This seems to be counterintuitive, but with yields at cyclical lows and investor sentiment very poor, the big four look good value based on long-term time frame, providing you can put up with the short-term volatility. Speaking of fund managers, embattled Queensland fund manager Blue Sky continues to fall as pressure mounts on their disclosure, or lack thereof. I'd really like to see some good news come from that stock, and perhaps a line in the sand with all of their funds being externally valued might be the place to start. As ever in this market, dodging the losers is just as important as picking the winners. On that note, I'll throw to Matt Gordon to see what stock he likes in this market this week. Matt.
Thanks, Tristan. Today I'll be discussing a new stock for your watch list called Jupiter's Mines, and the ASX code for this one is JMS. Before I begin, I'd like to mention that Morgans do not research this stock and in fact have nothing to do with it, but I may have a small interest in it and the advice is general in nature. Jupiter's Mines listed on our market on Wednesday this week with an IPO price of 40 cents and trades a touch higher at around 42 cents as of yesterday. The market cap is approximately 800 million, making it the biggest ASX resource listing since South32 spun off from BHP in 2015. Speaking of BHP, Jupiter's is chaired by Brian Gilbertson, who brought Billiton to the London market in 1997 and in 2001 merged the company with, of course, BHP. So what do Jupiter's do? Well, in short, they produce manganese. Manganese is mainly used to deoxidize steel in steel production and also can be used to reduce octane in gasoline. Also, there's been a greater use of manganese in the production of batteries, which could expand the overall market for the mineral. The manganese price itself has risen around 10% this year and is now above $7.50 a dry metric tonne, and Jupiter's are poised to benefit from current pricing as they own 49% of the Tshipi manganese mine in South Africa, which is considered to be the most profitable in the world. Everything about the Tshipi mine is world class. The ore body is part of the world's best manganese deposit. The infrastructure, including loading and rail systems, are new, and the profit flows have been excellent during the startup years. In fact, the mine generated 270 million in revenue for a net profit of 64 million last year, which isn't too bad. The mine is expected to continue at an average run rate of 3.3 million tonnes per annum, with the manganese price anticipated to hover around the $7 mark. Of course, as with any stock, there are risks associated, with the biggest one being the direction of the manganese price. But also being in South Africa, there is political risk, and the bigger the Tshipi mine becomes, the bigger a target for the black empowerment groups. However, even considering these risks, Jupiter's is still worth a look at, given the company has never lost money in the past 5 years of operation, even when the price of manganese went as low as $1.35. So with a 100-year mine life, no debt, and the manganese price well above long-term averages, Jupiter's is expected to produce a dividend to shareholders greater than 10% unfranked and trades on the PE closer to 10 times, which makes it appealing to more growth-orientated investors looking for exposure in the resource sector with a yield focus. Thanks, Tristan.
Thanks, Matt. I'm a happy buyer of Jupiter's as well for clients who have an assertive risk tolerance. Well, that's it for another wrap. Please feel free to share this video with your colleagues and friends and make sure you like the Morgans Edward Street Stockbroking Facebook page. Also subscribe to our YouTube channel below. Have a good weekend.